Hey, what's going on, team? Bennett Tyndall here from GodellTrades.com, bringing you lesson number one of a three-part series on the introduction to the Elliott wave theory. Now, I know a lot of you guys have been waiting anxiously for this series to come out, and this is just kind of going to be the basics. We're going to take a look at the Elliott wave patterns, and we're going to take a look at some of the rules and Fibonacci relationships and ratios associated with the different patterns. Lesson number two, we're going to dive into more pattern recognition, looking at live charts, and lesson number three will be completely devoted to working up wave counts from blank charts together and learning to better interpret the charts that we present to you guys within the platform. I think that's very important that you guys know how to understand these charts, know how to interpret them, know what to look for, know what the key levels are. That way you guys can begin to trade independent of our trade alerts. You can actually trade simply based on our analysis. Many of our users are doing just that and having a lot of fun at it, and I think that's really half of what this service is about. Absolutely, we love trading options together as a group. Traditionally, I'm a swing trader in the 1 to 3 positions per week kind of range, using Elliott wave theory as a trading methodology, and of course 1 to 3 day trades per week as well. But you can trade so much more. There are so many fantastic setups that we are presenting to you guys within the chart center, within the chart center on the platform and the portal for those of you who are non-full service subscribers, who are just newsletter only subscribers. So hopefully this video series will help you learn how to take advantage of that information and put it to use. So let's go ahead and, without further ado, go ahead and get started, dive into some of the basics. What exactly is the Elliott wave theory? You are probably asking yourself, is it voodoo? Is it magic? Is it crazy? Well, it's a form of technical analysis, and it's used to identify extremes in investor psychology, including highs and lows. So essentially support and resistance, key reversal areas within the market. Elliott wave, or EW for short, identifies moves between extreme optimism and extreme pessimism, and it's based on herd mentality. If you think about it as an investor, as a trader, if you're in a position, it's not going your way, the market's looking ugly, and you start selling, what do you think the other guy's going to be doing? The other guy, on the other side of the United States, the other side of the world, whatever it might be, the other side of the office, he's going to start doing the exact same thing. That creates very recognizable patterns that continue to manifest themselves and repeat over and over in financial markets. So who discovered it? Well, Ralph Nelson Elliott was the man who discovered Elliott wave theory. God bless his heart. Once you dive into the Elliott wave theory, you'll become part of the cult. No, it's addictive, guys. It's fascinating. Gives you an entirely new outlook on the markets, and it's just a really amazing and powerful kind of an art form. So in the late 1920s, he developed the wave theory, and he believed, contrary to popular belief, that stocks actually moved in cycles that repeat, and patterns that repeat over and over again, as opposed to the belief that markets trade in very chaotic and unpredictable manners. So I'm not sure if you're familiar with the Charles Dow theory, but he basically took the Dow theory, expanded upon it, associated patterns with it, and made it something really, truly amazing. So R.N. Elliott believed that the market moved like the progression of society or the economy, essentially in 3-step advances that are separated by 2 periods of recession or correction. A few facts about the Elliott wave theory before we dive in. Clear and recognizable patterns do repeat in financial markets, and they are identifiable using the Elliott wave theory. So Elliott wave is actually fractal in nature, and these patterns are represented and they transpire on various time frames, or degrees as we like to call them. So for instance, when you're dealing with a 5-wave mode of impulse, which we're going to talk about here in just a second, you've got a 5-wave move to the upside. This 5-wave move makes up a wave 1 of what's referred to as a higher degree sequence. Okay, then you go into a little 3-wave pullback, and that's a wave 2 sequence that is the same degree as this wave 1 here. Now, unlike traditional technical indicators that are, your MACD, your RSI, your moving averages, Ichimoku cloud, you name it, they are lagging. They are reactive in nature. They require price action to move. Elliott Wave is forward-looking, predictive, and forecasting in nature. Okay, it's really powerful, guys. I used to be a skeptic. I was a huge skeptic of the Elliott Wave theory for many years when I first started trading in the markets, and I bought into the lie that you can get 10 Elliott Wave practitioners in a room and they're going to give you 10 different wave counts, and that's just absolutely not true. I believed it for many years. Then I met Todd Gordon from CNBC. He introduced me to the idea that, in fact, Wall Street utilizes the Elliott Wave theory, and we're going to get into that right now. Who uses the wave theory? Well, banks, institutions, hedge funds, private investors, institutional investors, technical analysts, you name it, they're using it. It's not as widely discussed as some of the other forms, traditional forms of technical analysis, but it's almost like a gentleman's club on Wall Street. It is used behind the scenes. It's not very widely discussed and talked about, but it's an incredibly powerful tool. And I do know multiple technical analysts, senior technical analysts from Wall Street, who, after talking with them about it, all admit, yes, they use it. A lot of them, that's all they use, okay? They don't use traditional indicators because, like I said, they're lagging and they're reactive. They use wave theory because patterns develop and repeat, and that allows you to have develop some incredible context as to where you are in a market sequence, or the progression of the markets. I'm sure you guys are familiar with Paul Tudor Jones. If you're not, check out some of his stuff. Before we read this quote, Robert Prechter from Elliott Wave International, who's kind of informally known as the godfather of the Elliott Wave theory, he predicted the '89 crash 18 days before using the wave principle, and sent out a sell recommendation to all of his clients at the time. Robert Prechter is his name. So Bob Prechter, he's the champion, writes Paul Tudor Jones in his book The Market Wizards. He says Prechter is the best because he's the ultimate market opportunist. The reason he's been so successful is because the Elliott Wave theory allows you to create very favorable risk to reward ratio trades. This is the same reason I attribute a lot of my own success to the Elliott Wave approach. Okay, extremely successful businessman, extremely successful investment manager, using the wave theory and openly admitting it in his Market Wizard book. A lot of the guys on Wall Street, on Wall Street, banks, institutions, hedge funds, you name it, a lot of them don't admit it. A lot of them don't talk about it. It's almost like it wants to be kept as a trade secret. And one of the things, before we even get started, Elliott Wave has developed kind of a bad rep among a lot of retail traders, and this is my theory behind that. My theory behind that is so many people decide they'll play with wave counts for a week or two. They'll think it's too subjective. They won't understand the rules and the guidelines. It doesn't get them anywhere. Their counts are wrong 9 times out of 10, and they throw it in the trash. They think it's useless. Okay, this is not like a moving average. This is not like MACD, where you can see positive convergence, positive divergence. Your support on a moving average. Okay, buy the stock. It's not as simple as that. It does take some time. It does take some effort. Take some dedication, but it's absolutely worth it, and it will totally change your outlook on the markets. And another thing, so many people out there who call themselves wave practitioners will publish wave counts that are just so inaccurate, and it's really a pet peeve of mine. They won't even compare it to the rules. If you're not going to compare your count to the rules and the guidelines and make sure it's even a valid sequence, then don't waste your time, because 9 times out of 10 you're going to be led astray, and you're going to go down the wrong road with your trade. So if you guys are going to do this, if you're going to get serious about learning the wave theory, I'd buy Robert Prechter's book. Robert Prechter and A.J. Frost wrote a book called The Elliott Wave Principle. There's been multiple editions of it. It's a fantastic book. It's subtitled A Key to Market Behavior, I believe. It's available on Amazon, and it's a very in-depth read. I would say it's just as advanced, if not more advanced, than many of my college textbooks that I read. But it's second or third pass through the book, things start to click and really become kind of obvious after a while. Eventually, wave interpretation almost becomes second nature in that you can pull up a chart, you can identify key areas, major degree turns, and things of that nature. So if you're looking to learn more, of course, continue on this series. This is lesson 1 of 3. Get the book. Motive Wave, I think, is a fantastic platform for performing your wave counts. And the reason I say that is with traditional charting platforms, it takes you so long to manipulate your fib ratios, extensions, time projections, your retracements, doing your label stacking, changing the font even, and the degree of all your labels. It's so time consuming that you don't develop the repetitions, okay? Learning the wave theory is almost like working out, okay? The more repetitions you have, the faster you're going to learn, the shorter the learning curve is going to be. For instance, a wave count that would take me 30 minutes or 40 minutes in my old charting platform, I can accomplish in 5 minutes using Motive Wave. We are an official Motive Wave affiliate. If you're interested in purchasing Motive Wave, go to the subscriber portal on the website. There's a link there under the Motive Wave page that does embed our affiliate link. The main reason I encourage you guys to do this, I mean, at the end of the day, I just want you to purchase Motive Wave if you can afford it and if you're serious about Elliott wave theory. But the more business we can bring them as a group, as a company, the more likely they are to give us individual group promotions or free upgrades and things of that nature. So in the end, it will benefit the team as a whole. So yeah, pretty much every analyst I know who works on Wall Street or has worked on Wall Street knows about and utilizes the wave principle. I even know a gentleman who works for a foreign investment bank as a trader, an analyst. He's using the wave theory. A bit about wave theory interpretation before we get started. Essentially, every action is followed by a reaction. So you have actionary and reactionary movements within the wave theory. A 5-wave move follows the direction of the trend of one higher degree. Okay, so you've got a nice 5-wave move. That's following a trend of to the upside of one higher degree. So this 5-wave move here makes up wave 1. Then you have a nice 3-wave pullback. That makes up wave 2. Then you have another 1, 2, 3, 4, 5. That will make up wave 3 of a higher degree sequence, so forth and so on. 5-wave moves, as just mentioned, follow the direction of the main trend, which is essentially the trend of the highest degree sequence. A 3-wave move is a counter trend or corrective move, and it goes against the direction of the trend. And then a 5, 1, 2, 3, 4, 5, 1, 2, 3. This is what's known as a 5-3 move or a 5-3 sequence. That completes a cycle, which then becomes a subdivision of the next higher degree 5-3. And what I mean by that is you've got this 1, 2, 3, 4, 5, A, B, C. Okay, so that's 5-3. That's making up 1 and 2 of a higher degree sequence. Okay, and this is now a subdivision. This is now a subdivision of this sequence, and this sequence will continue to trade higher. 3, and then 4, and then 5, and of course within this wave 3, you've got a 5-wave move. Within this wave 1, you can count a 5-wave move. It's fractal in nature. Okay, so this 5-wave move makes up this wave 1. This 5-wave move makes up this wave 1. Depending on the time frame, let's say this is on a monthly chart, this wave 1 here, this 5-wave move, you could get down into wave 1, 3, and 5, and 5-wave moves within there. And within those waves 1, 3, and 5, you'll find 5-wave moves, okay? So it just keeps breaking down to smaller time frames or smaller degrees, as it's often referred to. There's only 13 patterns, guys, within the Elliott wave theory. It does seem complex, subjective. If you put the time in, you can absolutely learn these, and they'll become second nature. So we combine Elliott wave with Fibonacci. When you combine Elliott wave with Fibonacci, essentially Elliott wave is your roadmap, and Fibonacci tells you the duration and the magnitude of each leg of the journey along the sequence. So let's start off with the mode of impulse, and before we do that, I gotta put you guys on hold for about 20 seconds. Give me just 1 minute, please. All right, my apologies. So the mode of impulse, the basic 5-wave sequence. Let me bring out my pen here. So a mode of impulse is a 5-wave sequence, and it's labeled as 1, 2, 3, 4, 5, and it has a substructure of 5, 3, 5, 3, 5. And what I mean by that is this. Here's a 5-wave mode of impulse, okay? Wave 1, wave 2, 3, wave 4. You got wave 5 there at the top. Wave 1 here is going to be a 5-wave move. Wave 2 will be a 3-wave move. Wave 5, another 5-wave move. Wave 3, or wave 4, a 3-wave. And then wave 5, another 3-wave move. That's the substructure breakdown. Okay, that's how it decomposes. It's a 5, 3, 5, 3, 5. Here's a basic example of that. Waves 1, 3, and 5 move in the direction of the trend of 1 higher degree. Waves 2 and waves 4 are counter trend or corrective moves. They move against the direction of the overall trend. This is in a advancing market. If you're in a correction or a bear market, it's going to be reversed. So you have 1, you've got 2, you've got 3, you've got 4, and you've got 5. Okay? But you still have the 5, 3, 5, 3, 5 substructure. Some basic rules of the impulse wave or mode of wave sequence. Wave 3 is typically the longest. It does not have to be the longest, but it can't be the shortest, which means it can be the medium length. A lot of Elliott wave practitioners will are misinformed, and they think wave 3 is always the longest. It has to be the longest. That's not the case. Okay, it can't be the shortest, but it doesn't have to be the longest. It can be the medium length. 9 times out of 10, you're going to see wave 3 as the most aggressive and largest wave within a 5-wave sequence. Another rule of an impulse wave sequence is that waves 1, waves 3, and waves 5 can subdivide into impulse waves of their own. That's going back to the 5, 3, 5, 3, 5 structuring that we just discussed. A wave 1 or a wave 5 can subdivide into a diagonal, but a wave 3 can never subdivide into a diagonal. We're going to look at diagonals next. Waves 2 and 4, which are your corrections or countertrends moves, those can divide into zigzags, flats, or combinations. And your wave 4 is often a triangle, or can often be a triangle. You will never find a triangle in a wave 2 position, okay? So keep that in mind. The fourth wave triangle is going to be pretty much exclusive to a fourth wave. There's other areas where you're going to find triangles, but it's never going to be found in a wave 2. Your wave 4 never moves into the territory of wave 2. What I mean by that is this. We're going to talk more about this and exceptions in just a minute. Here's wave 1, here's wave 2, here's 3, 4, and 5. Okay, very clear 5-wave move, and there's no overlap. 4 does not fall into the territory of 2. So if you saw this, that would not be a valid 5-wave mode of impulse. Some guidelines. Now there are rules, there are hard set rules within the Elliott wave theory, and then there are guidelines that you can use to better identify whether or not your count is valid. So 4 and 2 will typically alternate the types of corrections that they exhibit. So that's referred to as the guideline of alternation. So if you find a wave 2 zigzag, or let's say you see a wave 2 flat, well then wave 4 you can expect a triangle or a complex or something else. Okay, they typically, waves 2 and 4 of the same degree will alternate what type of corrective patterns that you see within them. Your wave 2s tend to be zigzags or zigzag combos. There are times that your wave 2 turns into a flat, but more often than not you're going to see it as a zigzag, and that's because your wave 2 will generally retrace between half to 78.6% of the wave 1 impulse, or the wave 1 advance, or the wave 1 decline. A wave 4 tends towards a flat, a triangle, or a flat combination. We're going to talk about all of these corrective patterns in just a minute. Your third wave is typically the most aggressive angle of attack, or slope. So you have 1, 2, 3, 4, 5. Okay, so this third wave here is usually the most aggressive and widespread move. Okay, so you kind of got like early adopters coming in here, you know, double bottom chasers. Then you get this widespread participation in wave 3 correction, and then wave 5 is your widespread distribution. So typically of a 5-wave sequence, only one of the waves will extend. It's usually the third wave, and it's usually the same as the wave that extends of the higher degree sequence, or the parent wave that this entire 5-wave move is a part of. So let's say you've got a major 5-wave move on a monthly chart, and you see this wave 3 is extended. Within that wave 3, its wave 3 is usually extended, okay? And that's where you get your third of a third breakouts that tend to happen. When your third wave extends and your wave 3 is the longest, waves 1 and 5 tend towards equality. That's that 5v1 equality that we often talk about after we see an extended third wave advance. When wave 1 or 5 will extend, the sum of the other two motive waves are often related. I should have said. I put this together in a bit of a hurry to get this out to you guys, so I apologize for that. Are often related to the extended wave by Fibonacci ratios. And I'm going to be putting out later this week just a basic, kind of a cheat sheet that you guys can use for rules and guidelines and Fibonacci relationships when you're studying wave counts. Some impulse wave Fibonacci ratios. As mentioned, your wave 2 will generally retrace between 50 to 78.6% of the wave 1 move. Another way you can determine whether or not you're going to get a 50, 61.8, or 78.6 is to really identify the corrective structure. So if you're in a wave 2 and you've got support marked at 61.8%, but you get to, let's say, 50% and you have a completed corrective structure, and chances are your wave 2 correction is over and it's time to go to work in wave 3. Your wave 3 percent distance traveled is usually equal to, so 100% of, a 161.8%, a 200%, a 261.8%, a 323.6%, or rarely a 423.6% relationship of wave 1. And what I mean by that, if you were to measure the distance of wave 1, project it from the bottom of wave 2, and look for a 161.8% extension of that, that's generally your third wave target. So when we're tracking a 1-2 sequence, our first objective is equality, is the 100% level, meaning net distance, percent distance traveled here in 1, projected from 2. Equality is usually your first target. More often than not, you see at least a 161.8%. Wave 3 is usually a 23.6% or a 38.2% retracement of wave 3, but no more than 50%. And that's more of a guideline because, as we've mentioned before, waves 4 and 2 will often tend towards equality. So let's say you get to a 38.2% retracement here in wave 4 of this wave 3 overall advance, but 4v2 equality is down here. That's another very common target, okay? It's another very common target to for a fourth wave correction. So if you're in a fourth wave, you blow past a 38.2% retracement level, and you still have an ongoing corrective sequence or structure that is unfolding, your next key level of support will be equality of 4 and 2. All right, let's talk about diagonals briefly. So diagonals are either leading, they start a sequence, or they end a sequence. And they're either contracting or they're expanding. Here's an example of an expanding diagonal. Within an expanding diagonal, wave 3 is greater than 1. So distance traveled in 3 is greater than 1, and distance traveled in 5 is greater than 3. Hence these expanding trend channels that I have laid out here for you guys. In a contracting diagonal, 3 is shorter than 1, and 5 is shorter than 3. Hence the contracting trend line. So here you have 3 larger than 1, 5 larger than 3, expanding trend lines, contracting trend lines, contracting diagonal, 3 shorter than 1, and 5 shorter than 3. Some of the rules for a diagonal: well, a diagonal will occur as a leading diagonal in a wave 1 position or wave A of a zigzag. Ending diagonals will occur as a fifth wave or a C wave of a zigzag or a C wave of a flat. Now, ending diagonals have a 3-3-3-3-3 substructure. Just as we mentioned with the impulse wave, which has the 5-3-5-3-5 substructure, what you're going to find in a diagonal are 3-wave subdivisions. Okay? 3-wave subdivisions. A leading diagonal can have a standard 5-3-5-3-5 substructure. It can have a 5-3-5-3-5 substructure, but it's not as common as you might think. All waves of an ending diagonal and waves 2 and 4 of a leading diagonal will decompose or divide into zigzag patterns, okay? We're going to look at a zigzag pattern here in just a minute. In an expanding diagonal, we just talked about this, the relationships of 3, 5, and 1, and 3, 1, and 5, so forth and so on. Another rule of a diagonal is that wave 4 ends in the territory of wave 2. So with a motive impulse sequence, we don't want this 4v2 overlap. But in a diagonal, it's a requirement, Okay. Wave 4 can't end beyond 2, but it must end within the territory of wave 2. In a leading or expanding variety, wave 5 truncation is not allowed. In a contracting diagonal, truncation is also quite rare, and this is what I mean by truncation. So here's a 5-wave move, okay? Here's the high of wave 3. This is what's referred to in this example as a truncated fifth, okay? Up in 1, down in 2, up in 3, down in 4, and finally up in 5. Wave 5 failed to break the high of wave 3. That's referred to as truncation. That is not allowed. So for instance, if this 5th wave here only got here and it didn't get back up towards this this trend in this expanding, this would not be an appropriate diagonal pattern. Okay, so you can't have truncation. So the expanding, if 5 were to end, let's say here, that would not be a valid expanding diagonal. Now there are times when you need to allow variations. Okay, you need to allow exceptions of the rules, but learning when to do that and when not to do that, and when it's going to compromise your count or not, just simply comes with experience and time. Some of the guidelines of a diagonal pattern. Let me get my pen back. Generally, leading diagonals do have a 3-3, 3-3-3 substructure, and they're decomposed with zigzags. But waves 1, 3, and 5 can be impulses. Okay, we talked about that. A leading diagonal can have a traditional 5-3, 5-3-5 substructure. A wave 1 diagonal typically precedes an extended third. So let's say you have a contracting diagonal here for this wave 1, then you go into this little wave 2 pullback. That usually will precede a nice extended third wave breakout. A wave 5 diagonal rarely occurs after a non-extended third, so you wouldn't have and then a diagonal. Okay, it's very uncommon. Let's take a look at the corrective patterns that we've been discussing, and let's start out with the zigzag. Now, a zigzag is essentially a 3-wave correction, and its labeled structure is A, B, C. Here's a basic example. Down in A, up in B, down in C. Now, this is if we're coming out of, let's just say, for example, a wave 1 up, wave 2 down. If we're in a downtrending market environment, or we're in a correction to the downside, and you have wave 1 down, and then this wave 2 up, and then this wave 3 down, and this wave 4 up, this is going to be reversed. Okay, so instead of down in A, up in B, down in C, you're going to have up in A, down in B, up in C. And then that will complete wave 2. So everything gets reversed. Just keep that in mind, and that will be, I'll have all of these on the cheat sheet for you guys later this week. Some of the rules of a zigzag, well, we just said it's a 3-wave move where A and C divide into impulse waves, or rarely a diagonal. So you could have a diagonal for A, 3 up a B, and then just a nice 5-wave move down in C. Your B wave divides into a zigzag, a flat, a triangle, or a combination. Okay, so you could have a nice little 5-wave move. Then you could go into this A, B, C, D, E triangle. Then you get a 5-wave decline. And that would be down in A, triangle in B, down in C. And this is one of the counts that we have for the S&P presently. So we'll take a look at that in just a minute. Your B wave cannot move past the start of A. So you can't have, 5 waves down. That's just, I gotta erase that. That's terrible. That's terrible. You wouldn't have 1, 2, 3, 4, 5, 1, 2, 3, 1, 2, 3, 4, 5. Okay, that would not be a zigzag. So your B wave cannot move past the start of wave A. Some of the guidelines for a zigzag. C wave will tend towards equality of A, and it tends to move past the end of A. Another common C versus A relationship is a 1.618 or 161.8% extension, or essentially the distance of A times 1.618, a Fibonacci extension. So down in A, up in B. If you were to use your fib extension tool or fib projection tool in your traditional charting software, you would click once here, click twice there, click 3 times, and what that does is that measures this move down of A, projects it from the top of B, and you look for those fib levels, okay? And those are usually your C wave targets. Now, the beauty of motive wave, just as an example, is instead of spending time, clicking once, clicking twice, clicking 3 times, and projecting it, I simply hit a function key on my keyboard and it automatically brings up those ratios. Now, let's say you slightly move where A ends or where B is. In traditional charting software, you've got to go redraw that extension. Motive wave, it just tracks right along and it moves along with the waypoints. All right, so your B wave is typically a 38.2 to 78.6% retracement of A. Most common are a 50 to 61.8. So if you get 5 waves down of A, your B wave, you're looking for a 50 to 61.8% retracement before you get the C wave decline. Often establishes a trend channel, so you can actually get a trend channel from A and B, project it down. That usually gives you your C wave target. Just as with an Elliott wave trend channel to the upside, you can draw a trend line from 1 to 3 and project a parallel from 2 to 4. That usually will give you that 5th wave high. All right, when your B wave turns into a zigzag, typically B will retrace 50 to 78.6%. So some Fibonacci relationships and ratios. B, as mentioned, is a 50 to 78.6% retracement of wave C, or wave A rather. And then wave C is usually equal to wave 1, or more commonly a 161.8% relationship. So here's a great example of a zigzag, an ABC labeled zigzag, where your B wave actually turns into a nice little zigzag of its own. So let me grab out the laser pointer. You've got 1, 2, 3, 4, 5 down of A. You've got 5 waves up of this smaller degree A, 3 down in this smaller degree B, 5 up to make C of this A, B, C. That makes your 3-wave move in B. So 5 down of A, 3 up of B, 5 down of C. 1, 2, 3, 4, 5, A, B, C. 1, 2, 3, 4, 5. Within B here, you've got its own zigzag. 5 up of A, 1, 2, 3, 4, 5. A, B, C for B, 1, 2, 3, 4, 5. Here's an example of a zigzag where your B wave trades as a triangle. So 1, 2, 3, 4, 5 makes A, B, C, D, E. That's your triangle within this B wave. Then you get the 5-wave move down to complete C. All right, let's talk now about a flat. Give me 1 second here. I've got to switch something. All right, so the Elliott wave flat is another 3-wave correction that has labeled as a 3, 3, or is labeled as an ABC, and a flat is actually a 3, 3, 5 substructure. I had copied this from the zigzag, so that's why it didn't. Let's see if I can use the eraser. No, I can't. It didn't. I forgot to change it. I apologize. I'm trying to get this video out to you guys, and I forgot. But it's a 3, 3, 5. Okay, so 3 down of A, 3 up of B, and 5 down of C. Still an ABC labeling structure. Some of the rules of a flat. Your wave A cannot be a triangle. Your B wave must retrace at least 90% of wave A. So if we're coming out of a bullish impulse, down in A, up in B, B must get to a 90% retracement of wave A. If you're coming out of a bearish, a downtrend correction, and you're up in A, down in B, you must get to that 90% retracement. A, B. I'm doing this with my mouse, guys. I apologize. And again, it subdivides as a 3, 3, 5. Some of the guidelines for a flat, your B wave will typically retrace 100 to 127.2% of A. You're thinking, wait a minute, I thought it was 90%. We're going to look at that in just a minute. Your C wave generally demonstrates equality to A, which is the most common. Sometimes it's a 161.8% relationship of A. And again, that's projected from the top or the bottom of B. So say you're down in A, up in B. If you were to measure A, project from the top of B, man, that's horrible. It's hard to write with your mouse. And look for that 100, 1618. That's typically the Fibonacci relationships that you look for. Some of the guidelines of a flat. Well, your B wave, as mentioned, retraces 100 to 127.2% of A. C generally demonstrates equality to A. If B breaks the high or the low of A, it is what's referred to as an irregular or an expanded flat. If your C wave fails to end beyond the end of A, then it is a running flat. So let's look at some of those examples. You still have 3 waves down of A, 3 up of B, and 5 down of C. But in this case, the origin, wave 1, this makes wave 2, then we're off to the races in wave 3. This here broke the high of wave 1, okay? So this is what's referred to as an irregular and expanded flat. Amazon had one of these going into earnings. We were in a 4th wave corrective position. B wave rallied to new highs at like 1884 or something crazy like that. Everybody was bullish. Everybody was buying the breakout. And I said, guys, the correction's not complete. This is just an expanded flat, and we're getting ready to drop. And so what I did was I counted the 3 waves up of B, right? And I used a simple C versus A equality extension. So I projected what this C wave decline may have been. It happened to line up perfectly with what would have been a 38.2% retracement of the wave 3 advance. So we had 3 down of A, 3 up of B. Everybody was bullish, buying the breakout, thinking it was going to new all-time highs to break 2,000. We were like 1884, 1890. We had equality of C and A line up right at that 38.2% retracement level. I called that as a target. I said we need to complete the correction down to 1739.32, right? That was the level, the fib level that had key fib support, and it lined up for completion of the correction. Amazon sold off from 1884 or 1890, I don't recall exactly, down to 1739.32. It was 5 cents off. Equality of CNA and a 38.2% retracement. So absolutely remarkable. And that's just simply taking these patterns, learning to interpret them, learning to apply them. Because this is a great example of where you could see a nice wave 1 up. You get this move down. It breaks higher than this wave 1 top. You don't know a thing about Elliott wave. You buy this breakout only to see it sell off down to here. You get stopped out somewhere in the middle, right? Then it finds this wave 2 support zone, and then you get the huge 3rd wave breakout, and you're just frustrated. You're left, this does damage to your trader psyche. So knowing these wave counts, knowing how to interpret the patterns can kind of can really save you from making bad trades. Okay. Another rule of a mode of impulse, and I don't know if we covered it: up in 1, down in 2, up in 3, down in 4, up in 5. Wave 2 can never drop below the origin of wave 1. So you wouldn't have wave 1, wave 2, wave 3, 4, 5. Okay. This would then not be 1 and that not be 2. Okay. It would be something else like this, maybe a 1, 2. So 2 could not drop below the origin of 1. So that's another great example of how it can create very favorable reward to risk opportunities, in that you see a wave 1 up, 3-wave pullback down to, let's say, an extreme, a 78.6%. You want to go long for wave 3, you can take a position, and your stop loss is the drop under 1, because if it drops under the origin of what you see as wave 1, you know your count's invalid. You got to get out of the position. Another type of flat is the running flat, where your C wave fails to, touch or break below the end of A. And again, this would be reversed: up in A, down in B, up in C, in a reversed market environment. All right, guys. Some of the flat fib ratios that you can expect. Again, 90% retracement of A. C, and a regular flat is a 61.8%, 100% or 123.6% of wave A. In an irregular flat, your B wave typically is a 123.6% extension of A, and C is usually a 123.6 to 161.8% of wave A. Because let's say, for instance, in this irregular flat, since B is breaking the origin of A and longer than A, if you were to do equality, just a C equals A extension, that's not going to get you down to these levels. That's where the 161.8, for instance, or 123.6 comes in to play. And then in a running flat, you've got a wave B with a 123.6 of wave A, and a C that's a 61.8 to equality of A. And again, I'll have a cheat sheet out for you guys before the next video next week, and you can this should help you out just a bit. All right, the infamous triangle, the fourth wave triangle. Now, this is a 5-wave correction labeled as A, B, C, D, E. Here's 4 different types of triangles. You have an ascending triangle, where you have the top flat and the bottom rising. And again, this is representative of if you were coming out of, let's say this is wave 3 and this is wave 4. These wave points are going to reverse in a reverse market. So it'd be up in A, down in B, as opposed to down in A, up in B. Just keep that in mind, and I will include both patterns for you guys in the cheat sheet. Descending triangle, you have a bottom that's flat, and you've got this top trend line that's descending. The most common form of a triangle is a symmetrical triangle, where you have higher lows and lower highs, and that usually leads to the breakout. And then an expanding triangle, where you literally both sides of the channel are extending, or expanding rather. Some of the rules of a triangle, they subdivide as 3, 3, 3, 3, 3. So you would have 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3, if that makes sense. Now, you can never have more than one complex subwave, and they may only be a zigzag combo or triangles, meaning 1, 2, 3. Now let's say you've got 1, 2, 3, 4, 5, 1, 2, 3. You've got something else going here. You've got a complex that's not a 3, 3, 3. It is acceptable as long as you typically will only have one leg of that triangle that is a complex. And usually a triangle is going to happen in wave 4 most commonly, or wave B, of an A, B, C zigzag, as we looked at earlier. And it can also happen in the X wave of a combination or a complex. Subdivisions are typically zigzags or flats. Some of the guidelines of a triangle: your C wave is usually the wave that will be complex, if there is even one inside of the triangle that happens to be a complex. One wave can also be its own triangle. So you could have a C wave that's a triangle of its own, and that kind of gives you the 9-wave or 9-point triangle look. And then, of course, you can often find alternating 0.618 relationships within a triangle, as we've talked about several times in our weekly and daily videos. All right, last but not least, combinations or combinations of corrective patterns, and this is labeled with a WXY structuring. So here's an example where you have a flat and a zigzag, okay? And this is labeled with a W, an X, and a Y. So you've got 3 down of A, 3 up of B, 5 down of C. That makes up flat. The first correction within this combination or complex, that's your W wave. Then your X wave goes against this corrective trend and is often referred to as a connector, and that can be any 3-wave combination or any 3-wave correction. So A, B, C of X, and then you have a zigzag, 1, 2, 3, 4, 5 of A, 3 of B, 1, 2, 3, 4, 5 of C. That completes Y. Now this WXY combination is complete. Here's an example where you have a flat and a triangle combination, okay? 3 of A, 3 of B, 1, 2, 3, 4, 5 of W, 3 of X, and then 1, 2, 3, or A, B, C, A, B, C, B, A, B, C, D, A, B, C, D, A, B, C, E, okay? And that makes up your WXY. And then you can have double 3s, okay? So a WXY combines corrective structures, okay? A double 3 is 3 of W, 3 of X, 3 of Y to make up the larger degree W. 3 of X to make up X, and then 3 down of W, 3 up of X, 3 down of Y. That makes up Y, okay? So we're gonna dive into that here in motive wave in just a minute, but if you see a correction that's a 3, 3, 3, that's a combination. It's a double 3, and it's not a zigzag, and it's not a flat. Some of the rules of a combination, essentially a combo is 2 or 3 corrective patterns connected to one another by 1 or 2 corrective moves in the opposite direction. Those are often referred to as connectors. So W makes up the first correction, X is the connector, and Y is the final corrective pattern. If present, if there's a triple combination, you've got W as your corrective pattern, X is your connector, Y is your corrective pattern, X is your connector, and Z is your corrective pattern. All right, some of the guidelines, waves W and Y can subdivide into a zigzag, a flat, a double 3 of smaller degree, or a triple 3 of smaller degree. Wave X can be any corrective structure, essentially any 3, and really a WXY is a 7-swing structure. Here's some of the Fibonacci ratios. Again, I'm going to have this for you on the cheat sheet, so we're not going to really get into this right now. So some of the degrees, the grand supercycle, and these are approximate time frames. Now, a grand supercycle usually takes place and unfolds over multiple centuries. A supercycle is a 40 to 70 year. So that means a 5-wave move over 40 to 70 years is a supercycle movement. Your cycle is 1 to several, primary months to years, intermediate weeks to months, minor weeks, minute days, minuet hours, and subminuet minutes. Here is the labeling that you could anticipate out of these various degrees. So here's the grand supercycle, the supercycle, the cycle, the primary, the intermediate, the minor, the minute, the minuet, and the subminuet. And then these are the 5 waves with the trend, and these are the 3 against. So if you have an ABC capitalized in parentheses, that's an ABC correction of an intermediate degree. If you have an ABC capitalized that has circles around it, that's of the primary degree. If you have lowercase ABC, that's cycle. If you have lowercase ABC in parentheses, it's supercycle, so forth and so on. So I hope that makes sense, guys. And again, this is just kind of a basic introduction, talking about the patterns. I'm going to provide you guys with documentation which has significantly more in-depth details regarding these patterns. I just wanted to lay them out to you, and then we can dive into some classic examples of some of these patterns. And we're going to start off with the triangle. We're going to start off with a fourth wave triangle, and we're going to take a look at this in the S&P 500 following the January 26th highs from this year. Okay, fourth wave triangle. Okay, symmetrical triangle. Okay, you can see the contraction of these trend lines. A, B, C down of A, B, C up of B, A, B, C of C, A, B, C of D, A, B, C of E. There's a beautiful fourth wave triangle. Notice once this 5-point move for wave 4 is done, then it's off to the races. Okay, talking about the alternating 0.618 relationships, we just talked about this in the subscriber video update for Tuesday, I believe it was. Typically, you can find these alternating 0.618 relationships. So if we were to take D versus B, essentially you measure the distance of B, project it from the bottom of C, look for a 61.8% relationship. That will usually give you your D wave target. In this instance, it was calling for 2718.31. We had a high of 2717.49 before our 3-wave move down of E. Okay, just absolutely incredible example. Let's take a look at a fourth wave triangle on a 5-minute chart. You're thinking, really? 5-minute chart, huh? I know we looked at this one already, but we're going to look at it again. Right click, decompose, triangle, right click, analysis, show channel. 3-wave subdivisions. What's going on here? Huh. I just merged some extended data, so I'm thinking there's an issue there, and it's just giving me a bunch of blank bars. Edit instrument. Let me fix this, guys. It's going to drive me crazy. Actually, I don't think it will unless I clear this data, which... okay. Huh. Oh, my goodness. Oh, well. I can re-import the data later. No big deal. Let's talk about the alternating 0.618 relationships, okay? And look how beautifully this fourth wave triangle worked out to just that. Usually you're going to find at least one point that has an alternating 0.618 relationships. In this case, we found the last three, C, D, and E. So C versus A, essentially distance in A, projected from the top of B, look for 61.8% of that. That'll give you your C wave target. That called for 2734.70. We had a low, 2735.69. D versus B, so distance of B projected from the bottom of C. That called for 2744.90. We had a high, 2744.66. Absolutely remarkable. E versus C, so distance of C projected from the top of D. That called for 2737.26. The market gave us a low of 2736.86. Just a beautiful example of a fourth wave triangle. Okay. What other examples? Okay, so let's talk about a zigzag. Let's just talk about a basic 5-3-5 zigzag. It's exactly what we have here for the S&P 500. Let me do this appropriately. Following the September 21st highs. 1, 2, 3, 4, 5 waves down. Wave 5 ending diagonal. 1, 2, 3 of A, 1, 2, 3 of B, 5 waves of C. This initially, this A, B, C, that could have been all of this B wave, and then we were going to get the 5-wave decline. And that's initially how we were looking at this, as maybe a 1, ABC flat, 2, 3, 4, 5, of that C wave, of this intermediate degree, capitalized parentheses, C wave correction. Now, 1, 2, 3, 4, 5 of A, B, C. So this B wave turned into a nice expanded flat. Now we're getting ready to drop down in C. So the decline on Tuesday was either wave 1 of C, or if we go look at our alternate count turns this B wave into a triangle, just as we looked at in the example. 5 down of A, 3 up of A in this triangle, 3 down of B in the triangle, up in C, down in D, up in E. So we're dropping in either D of a B wave triangle before a 5-wave decline of C, or we're simply dropping in wave 1 of C, and this B wave was simply a flat. Here's why I'm leaning towards this being a flat. Couple of reasons. Okay. Traditionally, a triangle has 3-wave subdivisions. This here is a pretty clear 5-wave move, which would be appropriate for it to be a C wave of a flat correction. Okay, 3, 3, 5, where the triangle count would need to be some type of a 3-wave substructure of C. So the fact that this was a 5-wave move is indicative of the fact that this was simply C of a B wave flat, and now we're into the C wave of the higher degree 4th wave correction. Okay, so that's why I'm favoring this particular interpretation. Another example of a triangle. Let's take a look at Costco. Consumer staples. Costco loves triangles. Minor degree, 4th wave triangle. Okay, A, B, complex C, a 3 of D, 3 of E. Right, contracting symmetrical triangle in a 4th wave position led to the 5th wave breakout. We're in the same situation now, except we're in a 4th wave of a higher degree. So let's go to the daily, because this is kind of a weird count, but so this is a little 1, 2, 3, 4, 5. Okay, this 5-wave move makes up this wave 3 of a higher degree. This is a 4th wave triangle, which, if we go to the 195 minute, breaks down extremely well with 3-wave subdivisions: A, B, C, A, B, C, B, A, B, C, C. This kind of looked impulsive as the D wave move, but we're already getting the move back down. We're back down to 220, 226. Okay. Great example of a 4th wave triangle. And we put this out for you guys at 217. We were looking for the 61.8% D versus B triangle target at 231, and we got the move from 217 all the way up to 233, and now we're pushing lower. Great example of a triangle. Apple, let's look at Apple really quick for an example of a 335 flat. Okay, let's dive down to the 195 minute. Actually, we're going to need to go down to a 1 hour here. This is a 4th wave flat, or a flat in a 4th wave position, okay? 1, 2, 3, so 3 down. This kind of looks like it could be a 5-wave move, but this is really just a 3-wave move of A inside of this ABC. So decompose, correction, decompose, correction. ABC down of A, ABC up of B. Let's see if B gave us at least a 90% retracement. In fact, it did. It gave us nearly a complete retracement of the A wave decline. Then we got a little 5-wave extension in this C wave, decomposed impulse. If I were to take you to a smaller time frame, you would see how this is a clear 5-wave move. C demonstrated equality to A. That was at 215 spot 2-3. We had a low of 215 spot 3-0. 7 cents off equality of A. 3 down, 3 up, 5 down. Wave 4 is over. Time to move higher. What about typical 4th wave Fibonacci retracement levels? Well, we didn't even get a 61.8% 4 versus 2, nor did we even get a 23.6% retracement of wave 3. So we weren't even near your typical 38.2% retracement of the wave 3 advance, or near equality of wave 2 of the same degree, but we had a completed corrective structure. We had 3 down of A, 3 up of B, 5 down of C. C and A were equal. Time to go to the races, off to the races higher. Just a really great example of a flat there in Apple. All right, what else? Regeneron. Now let me show you another example of a correction which led to a move higher, and we've been tracking this one together. 1, 2, 3, 4, 5. Okay, you guys, everybody see that 5-wave move? Wave 2 gave us that 61.8% 2 versus 1 retracement that we always look for. Within this wave 3, a nice 5-wave move of its own. Within wave 3 of this, you've got a nice 5-wave move there as well. Decompose, impulse. Actually, I would have labeled it a little differently. 1, 2, 3, 4, 5. Motive wave's not far off, but really, I'd have to get down to a smaller time frame to really digest that the best, but let's just pay attention to the higher degree count here. So 5-wave move. This made up wave 1 of a higher degree. Then we went into a wave 2 correction. Wave 2 is correct between 50 to 78.6% of the wave 1 move. That would have been this 2 versus 1 retracement level here, and that would have been 327.22, and we got, let's see what the low was, 332.40. Very, very close. 3 down of A, 3 up of B. Actually, this is 1, 2. That's a 5-wave move. 5 of A, 3 of B, 78.6% retracement. Then a big old 5-wave move down. The correction's over. Time to go to the work on the long side. And this is what we were tracking, and we just wanted to see wave 5 not truncate, because wave 5 truncated. It did not end beyond 3. But we were expecting the significant breakout higher, and we made a move from 332 back to the 400 handle in a matter of, a week. Absolutely incredible move that you otherwise wouldn't have seen coming without the context that Elliott wave provides you. All right, let's take a look at an extended 5th wave. Taking a look at ticker symbol RACE, which is the ticker symbol for Ferrari. Up in 1, down in 2. Wave 2 gave us, drum roll please, 50% retracement of the wave 1 move. Then we had a wave 3. This wave 3 had a beautiful 5-wave subdivision. ABC for 4, diagonal for 5. That completed wave 1 of an even higher degree. Then we went into a nice correction, okay? Wave 3 clearly extended in the longest here. That tells us that wave 5 should be equal to 1. Let's go see how that played out. Right click on 5, ratio analysis 5v1. Equality was 152.40. We ended 149.85. Great example of equality a 5, and 1. You guys have seen the 61.8% wave 2 retracements numerous times in our wave counts. Was it Facebook? Okay, so here's a wave 2, 61.8% retracement. Primary 1, primary 2. Getting over to the weekly. Talking about the 38.2% retracements, okay? Actually, we've got, here we go. An equality of 4 and 2. Okay, you can see this fourth wave squares up to this wave 2 here. These fib ratios play out quite frequently. A 38.2% retracement of this wave 3 advance would have been 129.83, and we had a low of 126.85 before we started to move back higher. So that's a nice little example of a 38.2% retracement. Adobe, here's a good example of a combination correction. So we have a flat for W. Okay, B wave gave us an exact equality retracement of A, B, C. Triangle for X, A, B, C, D, E. Another A, B, C to complete Y. Equality was demonstrated of 4 and 2 corrections of the same degree. So we can go to the weekly to take a better look at that. Wave 2 here squaring up to this wave 4 here. Equality of 4 and 2 would have come into play at 205.20. We had a low of 207.02. This wave 2, exactly a 61.8% retracement of the wave 1 advance before we broke out into wave number 3. What else do we have? You know, that's about it as far as just some brief examples of some of those corrections. I'm going to cut it here. We're about an hour and 15 minutes into this video. I wanted to keep it a little bit shorter than this. Mostly just discuss the basics, some of the rules, where Elliott wave came from, what you can expect out of this course, and in lesson number 2, we're going to spend about an hour, hour and a half going over numerous examples of all of these patterns. We'll go through the patterns in order, talk about the different patterns, look at real-life examples of them as we've done here just briefly. And then in lesson number 3, we will start to do wave counts together. We'll talk about the logic behind certain wave counts and progress towards better chart interpretation. So I hope you guys enjoyed this kind of introduction to the Elliott wave theory, lesson number 1. Again, this is just the very basics to get you started, get you understanding what wave theory is all about and where it all originated from. So I hope you guys have enjoyed this video, and I will see you for lesson number 2. Have a good one. Take care.